Hi guys, Paul Seils here from Conscious Investor Network. I've got Derek Whitaker with me. I met Derek about 5 or 6 years ago, and I want to talk to Derek for those people in our community that are interested in stock options trading. Hi Derek, how are you going?
Hey, thanks for having me. Fantastic to be here. How are you?
Great, great. A little bit wet on the East Coast, but well.
That's why you got to come over to sunny Perth, man. It's always and we got sand here for sand gropers. It just drains really well.
So some people in our community are interested in stock options trading and that sort of thing. I was wondering if you could sort of demystify some of that for us. And I know you do training and development education in this area as well. If you can talk to us a bit about that, please.
Yeah, I'd love to. I'd love to. Look, guys, thanks for joining us today. It's one of these topics that, once you get into it, it can be quite addictive. If I'll put up my slide here, put up a little presentation for you guys on how to potentially make profits safely in volatile markets. And I think that's the big mystery at the moment is the markets are incredibly volatile and people are nervous if they have holding onto stock. And the honest truth is, if you're holding onto stock in volatile markets, you are very vulnerable, very, very vulnerable. What we do though, is we know how to 100% capital guarantee different positions that we do in the markets. And also we chase the volatility. So we're looking for where the scary headlines are. We're looking for where the greed and fear, those big emotions of the market are. And we go and embrace it to set it up for profits, which is really, really exciting. So we do a bit of a contrarian type of approach to the markets. So if you're a bit counterculture in your thinking, you'll love this because we do the opposite of what most investors do. We think very, very differently in our approach. Before I start, though, I do need to put up a disclaimer. We need to tell you up front, we're not a licensed financial planning, accounting, or law firm. We're simply an education company who'll give you factual information. We do not give you general specific advice around finance, business, investing, options, trading, or anything else. That's not what this presentation, of course, does. Please see a licensed financial planner when it comes to any investment advice you need. Look, on an individual level, I'm a dad. I've got 4 beautiful children, a gorgeous wife. On a professional level, I'm also a partner with a group that trade for wealthy people, basically. We trade the markets for them. And it's a big responsibility when you are trading other people's money because it's really simple. If you're making money for them, they're happy. If you're losing money for them, they're not happy. It's really black and white in this game. That's Shaquille Latimer, my business partner there. And we have a team that work with us in trading the markets and doing other private investments that we do for our clients. 10 things I wish I knew before I placed my first trade. I'd like to just go through this because I understand the process of being a complete newbie at this and not knowing anything and where to start. And I think we were talking off air on this, Paul, and the biggest challenge when you're starting is how do you pull all that information that's out there on the internet together to develop a system to trade by that gets consistent results. Mm-hmm. And the key is their consistency, all right? Anybody can take a punt and get it right, and it's great beginner's luck, but to do it consistently over and over and over really separates the punters from those who are the traders, the professional traders. And I think that's really important to understand. Trading is all about risk management. That's the number one thing I wish I knew before getting into this game. It's all about risk management. So we know what the upsides can be. We know that there's a potential to make infinite wealth when it comes to the markets. What you've got to consider is the downside. And that's what we're always looking at, which is a kind of contrarian view, especially if you're a business owner. Well, I've seen business owners will take a risk on the next generation's inheritance to do a deal and to make a business successful and chase that. You do that on the stock market, you're setting yourself up for a lot of pain. And that's one of the really important things to understand, especially if you're using margin in the mix, which is lending or money borrowed from the broker. And so it's all about keeping your eye on what happens if this goes wrong, because the market can do strange things at a whim and there's no logical sense to it. Why is there no logical sense to it? Because the 2 big driving emotions when it comes to trading are greed and fear. And it goes into hyper mode. The market always over responds when it comes to those 2 emotions. The second part that I would have loved to know before I started this whole journey is 80% of trading is mindset, 20% is technique. How you think between the ears here makes all the difference between whether you are a successful trader or not. 20% is just execution. It's just easy. It's pushing the buttons, going through the process, all that sort of thing, developing a method but how you respond to the markets makes all the difference in the world. And you've got to develop that. It's like building up a muscle. You go to the gym, you build that muscle, and there's a bit of pain. And I always teach my students, look, you'll get the biggest lessons when you make a losing trade, which sounds odd, but it's the truth. You learn more on a losing trade than you do the winners. Now, don't get me wrong, I'll take the winners every day of the week, right? I'll take them, love it when they come easy. But it's when you get into a corner, it really separates the punters from the real traders and who knows what they're doing. And it's really important and key to keep that in mind. It's always a process of learning, always learning. And I'll touch on that a little bit later as well. So how you interpret things in the market, how you look at things, how you view things, that filter is really, really key in terms of success. Number 3, trading is a different mindset than investing. And I've alluded to this. Knowing how to exit is more important than an entry strategy because the end result defines the setup. So what we do as traders is I don't really care if it's a great stock. That is not important to me. Well, to some extent, okay? I'm not going in looking at fundamental analysis so much. I'm not wanting to hold on to this stock for the next 5, 10, 15 years and seeing if I'm getting this company at its growth stage or just before its growth stage before it explodes. That doesn't enter my mindset. What I'm doing as a trader is I'm looking for different results. Either I'm looking for cash flow, all right? Or I'm looking for some capital growth. I'm looking for protection. I'm using these instruments in the market to do various different things. And so I'm not emotionally tied to the company. I used to work in law, accounting, financial planning firms, high-end law, accounting, financial planning firms. And I always could spot a client who came in or someone who was wanting to be a client. If they started talking about, hey, I've met the CEO, as soon as they say those words, I knew that they'd probably fallen in love with the share and the company. And that's a real danger because you don't want to fall in love with your shares, all right? Because if you fall in love with your shares, you're making emotional decisions and not smart decisions when it comes to the markets. When you trade options, they have an expiry date. So it could be a week, it could be a month, it could be 6 months, it could be a year, it can even go up to 2 years. You don't care. You're not hanging on to that option for anything. It's merely an instrument to dance around various shares. And the great thing about that, it separates your emotion and your emotional ties to the underlying investment. I always know that I can take profit from a particular stock or trade, bank it, and then if I want to be back in that trade, I can go back into it and reset it, right? I always can come back if I want to, or if I want to let it ride out for a bit. The problem I see is like, the Australian love affair with BHP, okay? Let's say BHP is trading between $60 and $70. I've just pulled those figures out of the air, right? And they've had this stock for 10, 15 years. And what happens over the last 5, 6 years, BHP's gone up $6, down $5, up $3, up $2, down $7. And it has a range bound where it's just trading in between that. As a trader, I can take profit from those movements, those small movements. So while the rest of the market is just holding on and hoping it will go somewhere, as a trader, the best analogy is I'm like an owl in the tree. I'm sitting there perched on the branch and I'm going, hoo, ancient wisdom, seeing the greed and the fear of Wall Street go crazy, the madness of Wall Street. And I'm looking at it and going, okay, I see an opportunity here. I'm going to launch myself off the branch, sweep down, take that profit, and I'm going to take it back up to the tree where I know it's safe. And I'm going to bank that thing, right? And then once I enjoy the spoils of that, I'm going to do it again. Who, ancient wisdom, look for another opportunity. I'm not in there hoping the market will do this, hoping the market will do that. I've got a very strategic plan on how to get in, and more importantly, how to get out. I have a defined exit strategy. And I think that's the biggest difference between a trader and an investor. I see so many mum and dad investors have no exit strategy. They go in hoping and praying it'll go up, but they'd never define when a stock is low, when a stock is high, and how on earth they're going to actually take profit and when they're going to take profit. They just leave it. And what happens is that stock may go up, but guess what, guys? It can also retrace and go back to where it came from again. And they've actually missed out on an opportunity on that movement. Or it can go the opposite way. It can go down. And that's really important to understand too. I'm going to show you a little bit later, but we don't care if it goes down. We set up trades and we don't care if it goes up. We don't care if it goes down. As long as the thing moves, we're happy because we can make it money in either direction. And that just opens up a whole new thing. In fact, in March of 2020, when the market crashed, we absolutely cleaned up in our partnership. We absolutely made a killing on the markets. And it was really weird because you had all these scary headlines about COVID, and internally we're grinning from ear to ear because we've just made a bucket load of money. In fact, I just moved into this house just before it happened, and I met the neighbor. He was out and doing his garden. We're all in lockdowns. Hey, mate, how you going? And this sort of thing. We just moved in. And he happens to ask me, what do you do? I says, oh, we trade the markets and that sort of stuff. And he goes, oh, man, you must have been really had a rough week. And I said, no, actually, we've done really well. I didn't tell him how well we've done, but inside, I'm playing it down, and it's kind of weird to be in that strategy of we've just cleaned up while everybody's lost a fortune. It's a weird feeling, but it's that black swan event that can come along that gives you this, what I call the sleep at night factor. I don't want to be worried about my trades up at night, worrying about them. I want a clearly defined strategy of how to get in, how to get out. And if it doesn't go according to plan, I've got all these mitigation strategies to make adjustments to protect my capital. How many of you think, that's something that is really valuable when it comes to the market? It's a clearly defined process on how to do that and how to get out. Number 4, it's easy to get into a trade, but it's more important to know how to mitigate it when it doesn't go your way. And that's really, really important. We want smooth sailing. I know you're into boats, Paul. And we want smooth sailing when it comes to the markets. And what to do, we want a defined process. If this thing doesn't do what we want it to do, not to worry. We engage 1 to 4 different strategies to mitigate that and to ensure that we are protecting our capital at all times. Number 5, a trader needs to be greater than a one-trick pony. That's really, really important. I see a lot of educational courses out there, and some of them are probably terrific and great, but I've seen them, they sell one strategy for up to $6,000. And I'm going, that's great, but you know what? If the market changes, that strategy is not going to work. Right. So in our courses, I teach, anywhere between 6 to 9 different strategies, right, throughout the process. And I'll talk about that a bit later. But the handy thing about that is when you start becoming more sophisticated in this game, you can apply the theory of one other strategy to a strategy you're already doing, and you can overlay it. And so you can get all these different moving parts into a particular strategy. One of our advanced strategies that we teach in our business is that we can show students how to 100% capital guarantee any stock they buy with only a 5 to 6% risk on that trade, right? And then we show them 16 different adjustments they can make to reduce that 5 to 6%. So what they're left with by the end of it is a free bet, right? We want to get that 5 to 6% out, and then they're left with a free bet in the market. How many love a free bet? It's fantastic, right? And you can have about 8 or 9 of those different free bets. So let's say 10, just for round numbers. You can have 10 of those kind of trades going on, and maybe 8 of them, are small gains here and there, but nothing life-changing. But you have 1 or 2 of those that just go bang. That can make a huge difference to an account and someone's wealth. So that's the kind of approach we take with that. And to do that, to get to that level of sophistication, you need more than one strategy. I've often, in defending an account too, used or applied what I know from a different strategy to what I'm doing, just to give it more defense. And that's when you're getting quite sophisticated. So yeah, I'm not into churning out one-trick ponies. Number 6, a trader must be disciplined but flexible enough to adapt to changes in the market. So there's a real level of discipline, particularly in 1, defending an account, and 2, taking profit when it presents in the market, but also be flexible enough to understand that, hey, the market will change, and what it's done last year, it may not be doing this year, okay? You can't be so rigid that you go, I'm going to just do this and do it this way. We had to, in 2022, at the beginning of that, adjust what we were doing with our students who'd gone through this process. And it was just a small adjustment, but that small adjustment made huge difference in the results. Then come 2023, again, at the beginning of the year, we adjusted again. Why? Because the market had changed. It was just a small tweak, going back to the basics again, and that made a big difference for our students. So it's having that flexibility to know when to apply things and when not to, which is really important. A trader must always be learning. Number 7, deeper rather than wider. The funny thing is when you get into the finance industry, there's always something to learn. There's not a week goes by where I'm not learning something new as well. And I've been in this game for, oh gosh, since 2007, the end of 2007. So I was learning something new every week and still continue to learn. And I think it's really important to go deeper rather than wider. Rather than trying to eat the whole smorgasbord, really pick what works for you and then just go deep on it. Find that generally works. I have heard of traders who, in foreign currency pairs, in Forex trading, they only trade one pair and they become experts in that one pair. They know how that setup works. They know what to look for. They just know that, build that character. Each derivative can have, I describe them as little characters that play in the game of the market, and they get really good at that one thing. That's pretty common with traders, where they just go deeper rather than wider. Rather than trying to do 9 different strategies, they're actually going, you know what, I'm really good at this. I'm going to focus on this because this gets me the biggest results. Another one is understanding the 3 stages of learning as a trader. Mark Douglas has written a pearler of a book called Trading in the Zone. I highly recommend you read this, or at least get the audio book on it. It shows the mindset of a trader, and this is recommended reading for our students as well, so you're getting a bit of an insight of what I teach them. There's 3 stages, and basically they're summed up this way. When somebody starts this game, they copy what their mentors taught them to the T. Right, that's the first stage, real copycat type of approach. The second stage is when they get a little bit of confidence and they see it work, they see it, they understand it, and then they start to just put in their own flavor. They start to just try a few different things that their teacher didn't necessarily show them or the mentor didn't show them, and they just start tweaking it, a bit of trial and error, and they learn that way. And the third level of learning as a trader is the one of mastery, right? Where there's a bit of instinctual knowledge where they take all the information and data that they've gathered over the years, know what they know about the markets, know about their trading strategies, know about their mitigation plans, and they just kind of get this sense of what's going to happen in the market. And they learn to trust that and go with it, using, of course, the very discipline and guidelines that they've already designed. That's the final layer of trading. So great little book. If you get a hold of that, if you're really into this sort of stuff, you'll learn a lot from that book. Number 9, 3 factors that affect the stock market are understanding this: politics, the economy, and interest rates. I used to wonder and scratch my head why on earth I could buy a stock and everything check out on it, right? You do the fundamentals, you look at the earnings, you understand what the company does and what it's projected to do, its business plan, its model, all that sort of stuff. And then you finally buy that stock, and what does it do? It absolutely tanks. And I used to understand why. Why does it do that? And what I began to understand is there are 3 factors that are interrelated here that affect the stock market. Number 1 is politics. Number 2 is economy. And number 3 is interest rates. And what I'll do is I'll show you a bit of case study a little bit later and show how those 3 are interrelated. But they usually can be drawn down to that. There's also the black swan event. So black swan event being a September 11, a COVID-19 type of event that can just shake the markets. But generally, those 3 are the ones that affect the stock market. A political decision is made. That affects the economy, and then the interest rates are responded by that. And what I mean by interest rates is what the central banks do. So I'm primarily referring to the US market, in this case, the Federal Reserve. If you want an Australian equivalent, the Reserve Bank of Australia is also that scenario. And number 10, the different types of trading. There are numerous sorts of derivatives to trade. There can be stocks, there can be foreign exchange, commodities, futures, options. I noticed a trend when I worked in those firms that a lot of experienced traders who'd done most of those would always come back to options. So in my thinking, I thought, I'm going to go to where they always end up rather than chase everything else. I'm going to look at that and try to get really good at that. And what I noticed with options was it was the most suitable thing for my lifestyle. I had some guys who were promoting futures and all this sort of thing. And I was in a situation when I started this journey where my wife was recovering from chronic fatigue. And so over here in Perth, the markets would open at midnight on the East Coast, which was 10 o'clock my time. And if my wife didn't go to bed by 9 o'clock, she was wrecked the next day. That's how bad her condition was when we first got married. And so I realized that if I was going to make this work, I had to choose something that was going to work in our lifestyle. And so an option that really worked in terms of, I didn't have to be a day trader. I didn't have to sit on the markets all night long, watch the movements go up, down, and all that sort of stuff. I could actually put on a trade, go to bed, and not have to worry about it, provided I got the strategy right. And then I just developed a lifestyle to work with that. And that's what worked for me. And that's what I always say to guys, particularly people starting on this journey. They usually can't quit their job and just start trading with no experience. They've got to build up to that. Now that we trade money for the other wealthy people, there'll be times where we do an all-nighter, but we're talking 7-digit figures when we're putting on these trades, okay? So there's a bit more responsibility and probably a bit more reason to stay up late at night to do so, okay? How many of you would stay up all hours if you were doing those kind of numbers? It just makes sense. The bigger the business, the bigger the responsibility. Hey, but bigger the reward when it comes off. So that's 10 things I wish I knew when I was starting out on this journey. Just to give you a little bit of background on options, options commenced trade on April 26, 1973. They've been around a long time. And the Chicago Board of Options Exchange, or CBOE, started trading over 16 various stocks. So they've been around a long time, and I don't see them going away. You can even do options on crypto, okay? Not that that's not a recommendation to do so. And the rules around that are not as flexible as the stock market. You got to remember, guys, that the crypto market is tiny compared to the stock market, okay? In terms of the billions and billions of dollars that are pumped through the stock market. I mean, $1 trillion is done every day on foreign exchange, just alone, okay? That's huge, huge numbers. So it's very liquid in terms of that, whereas the crypto doesn't quite have that liquidity in place. So options operate and they give you a lot of leverage, okay? There's 3 reasons people trade options. Number 1 is to protect their portfolios, okay? That's why they originally were designed. A lot of people think, oh, options trading is dangerous. They don't really understand the true heart of options. And that was, you could metaphorically insure a stock portfolio. So let's say stock's trading at $20. I can buy an option and protect that $20. So even if it goes to $10, even if the company goes out of business, I have guaranteed I'll get $20 for that stock. All right. And that's powerful when you think about that. That means me not worrying and laying awake at night worrying about the market crashing. That means that I can sleep better at night knowing that my wealth that I've worked hard for is protected. The second part of that is really, really interesting when you look at leverage. Options on the US market, 1 option equals 100 shares, is equivalent to 100 shares. So what it means is you can buy for a small outlay, control a huge, huge amount underneath that option, all right? You can control, for 1 purchase of 1 option, you can control 100 shares rather than having to buy 100 shares, right? So let's say you had $10,000 and you're buying $10,000 worth of ABC stock. Well, a trader can do that, or they can try to get more bang for buck by diversifying it a little bit and going, you know what, I'm going to put a portion of that, but control the same amount of stock as if I had owned the shares, right, itself. Wall Street, being Wall Street, likes to speculate. And that's when speculation gets dangerous with options, and when people get the greed kicking in and it gets out of control. So it's really keeping those emotions of greed and fear right under wraps and being master of them rather than they master you. Back then in 1976, you could generally had to trade an option over the precise amount the stock was trading. So it'd be something like an awkward number of $25.34. And it was difficult to trade down an option during the time it was relevant for, whether it be 6 months and 10 days, 95 days, 65 days, 35 days, you name it. So they standardized these things. And it was that awkward thing, an investor would have to wait until the options expired. Well, the great thing is you don't have to wait anymore. The Chicago Board of Trade standardized the over-the-counter market soon after putting in fixed prices and fixed days of expiration on contracts, which means there's more opportunity to buy and sell an option before it actually expires. So let's say I buy 5 contracts at $20, everybody's going to be going, right, the next strike price is $21 up or $22, but I get a lot of action at $20, which means I can get in and I can get out of a particular trade a lot easier. So you might be wondering, all right, what is an option? This is the easiest definition of an option. Options are a financial contract. That's really important to understand. They're legally binding. They're a contract to buy or sell a unit of shares over a certain stock at a specific price point during a defined time frame. Now, there's a lot in that, so I'll read it again. Options are a financial contract to buy or sell a unit of shares over a certain stock at a specific price point during a defined time frame. I love the defined time frame thing because it means I'm going to get a result in a certain space of time. Either this is a winning trade or it is a losing trade, or I can be clever about it and roll out the trade, which is getting a little bit more advanced, but there are, no pun intended, options. But this is the thing about defined timeframes. It's different from someone who buys a stock, holds on to it, and hopes that something will come of it, right? And waits and waits and waits and waits and waits and waits. I know that something has to happen, maybe 6 to 8 weeks out before that thing will give me a result. And so as a trader, it gives me incentive to get a result, but it also means that I can make money potentially faster than if I'm just holding on to it forever and a day. The stock market exists to raise capital for a company. Many big corporations started very small and humble beginnings. We've got IINet. It was a company that started in a few servers in someone's garage. McDonald's, Apple, Dell Computers, through to Walmart. No matter how you feel about these companies, we have to recognize they all had humble beginnings. And this is why people put them on the stock market, because they need other people's money to actually do what they got to do. As I mentioned, these are the 3 reasons options are traded on the stock market. The trader uses them. 1, for income, right? They can, probably the easy example to understand this is a trader or a stock market person an investor who buys stocks that pay dividends. They're wanting that quarterly or 6-monthly or annual dividend every year, right? It's a bit of a bonus. Who doesn't like a bonus? Well, as an options trader, I can do that weekly. I can do that monthly, 6-monthly. I can pick whatever I want, how often I want to be paid, right? And that flexibility is absolutely huge when it comes to income-based trading. Then there's the second one, as I mentioned before, hedging protection. Just the fact that I can metaphorically insure a portfolio of shares makes a difference in the world. You know, when I did this and got into the game and had made my donations to the market before I knew about options, as we all traders do, in other words, we'd lost money. When I discovered that you can metaphorically protection, it just changed the game completely. And the third one is leverage, right? So because in the US, it's a 1 to 100 shares, for a small outlay, I can control a greater number of underlying assets, which is huge, okay? So imagine if I bought one option that controls 100 shares. Let's say I buy it and the share's trading at $200. Well, imagine if I bought 10 options, 10s times 100, right? Do the numbers. Now I'm controlling 1,000 shares at that price, at $200 a pop. And you start doing the numbers. I may not be able to afford that much exposure to a $200 share, but for a smaller outlay, I can still get a piece of the action and do that. And I'm going to show you some of the leverage some of our students got in a minute on this. Traders, as I said, income, hedging protection, and leverage. Those are the 3 reasons that they do this. There's also within that the strategies. And this is what I love. I wish I'd known this framework when I was starting out. It would have made my path a lot cleaner, a lot smoother going through it. It's like, you know, what I wish I knew, what I'd teach my younger self, you know. And the first one is first dimensional. It's buy low, sell high. We've talked about that. The problem is when is low, when is high, when is a stock low, when is a stock high, and when do you get out and take that profit? The second dimension, that's pretty much where the mum and dads play at, all right? The second dimension are directional strategies, and these are not income-based, that should be directional strategies. They're trying to pick whether it's going to go up or down or sideways. The market can only go 3 directions, up, down, sideways, okay? So they're trying to pick, is it going to go up? Is it going to go down? Because you can make profit on the market going down as well, and you can even make profit on the market going sideways. But they're trying to pick which direction will go. It's great when you get it right, but boy, it can hurt when you get it wrong. And that's what we've got to look at as well as the downside of it. Now the income-based strategies, the third dimension is time-based strategies, okay? And again, the easiest one of that is the dividend collector who buys a stock to collect that dividend. As I've mentioned, you can do that with options as well, weekly, monthly, yearly, whatever it might be. And the fourth dimension, which is no doubt the most popular amongst our students, probably 98% of them do this strategy, is non-directional. So I don't know if it's going to go up. I don't know if it's going to go down, but I'm going to put a trade on. And what I'm going to do is if it goes up, yay, I make potentially profit. If it goes down, yay, I still make potential profit. And I've eliminated the guesswork of stage number 2, trying to pick the strategy of the direction. The beauty of this is that even if I get it wrong, even if I think a stock may go up and I get it wrong, I still potentially can make profit. And I think that's really, really cool in this day and age when the markets are really shaky, really volatile. That's a cool position to be in, right? And so what we do is instead of running away from the volatility, we're going, where is it? Let's embrace it. Let's be where the action is, right? That's a really cool position to be in when going for this stuff. I love what I've had about 3 mentors in my trading life. And my second one said this. He said, you hear this when the market does something and traders are sitting around, oh, this market, they complain about it. This market is shocking, this sort of stuff. And he said, the problem is not the market is wrong. The problem is the strategy is wrong. There's a little gold nugget in there, okay? If the strategy can't survive what the market is doing, there's something wrong with the strategy, right? Rather than blaming the market should be doing this, the market's not doing what it should do. The market's going to do what the market's going to do, right? And as a trader, I've got to have the right strategy to be able to handle whatever it might do and come what may, all right? And that's really important in terms of the approach to the markets. So in summary, trading is all about risk management. 80% of trading is mindset, 20% is technique. Trading is a different mindset than investing. Knowing how to exit is more important than an entry strategy because the end result defines the setup. It's easy to get into a trade, but it's more important to know how to mitigate it when it doesn't go your way. Number 5, a trader needs to be greater than a one-trick pony. Number 6, a trader must be disciplined but flexible enough to adapt to changes in the market. Number 7, a trader must always be learning deeper rather than wider. Number 8, understand the 3 stages of learning as a trader. And number 9, 3 factors that affect the stock markets. We talked about that: politics, economy, and interest rates. And number 10, understanding the different types of trading. So there's a neat little summation for you on the 10 things I wish I knew before I placed my first trade. Now, I just want to shift gears for a moment and show you what's happening in the markets now and what's been happening over the last 5 years, okay? This is a 5-year chart. And over here, round about, remember on this part here, Trump was in power in the US, all right? This is the S&P 500, which is the top 500 stocks on the US market in the dark blue. The NASDAQ, this is an indice which is the tech shares, okay? So your Google companies, your Meta or Facebooks, Zoom, these kind of companies are in here, all right? And then the Dow Jones is the select top 30 or 30 shares, and that's another indice that you'll hear quoted on the markets a lot. So we look at how those 3 compared over this time period, okay? Now, back in the day, back here, America was coming out of recession, all right, from the Obama era. Trump gets into power and bang, it goes up all of a sudden, okay? And the market goes, yippee, we've got a Wall Street guy in the markets, happy days, right? One of the first things Trump does is he changes taxation. He lowers company tax. He also says to investors and big companies, he's saying, we want to get American jobs back on American soil. And he reduces the offshore tax penalties for companies who have money offshore. He says, you bring that money back in America, I'll reduce the tax rate for you over this period of time, and you can bring that money in here, because he wanted industry back in America. He wanted to get Americans working again out of the recession. Well, these political decisions created the economy to get hot again, okay? More money starting to flow into the market because companies are paying less tax, businesses are upgrading their systems, paying more for their infrastructure, putting more staff on, and suddenly you've got things starting to hum, right? And it's coming out of recession. The problem with that is when the economy starts churning at a really fast rate, inflation starts to go up. Whoa, so what happens next? The Federal Reserve goes, we need to hike up interest rates, okay, because they're all at time lows. So you can see how those 3 factors are interrelated. A political decision hots up the economy, and the economy is getting hot, so the Federal Reserve kicks in with the interest rates. Those three factors affect what the market does, all right? America puts their stock market at all-time highs until, of course, the Biden administration comes into play, okay? We know the controversies over January 6th and all this sort of stuff that went on and what's coming out with the Twitter files and all this sort of fun stuff, all right? Now, just looking at it from an economic perspective, all right, I'm not going into the politics so much, but this Biden administration, what they had is a policy that wants to kill fossil fuels. That's been probably the biggest effect on the economy and the stock market of the US. Now, this little dip here, this is COVID. This is when all the lockdowns are happening. The market, you can see how it overreacts. It went crash, crash, crash. And this is where we as a trading group absolutely cleaned up on these crashes because we were non-directional in the play. And we're going, yippee, let's make a fortune. And that was a big move because it crashed and it kept crashing and it kept crashing. Then, okay, once it gets that out of the way, it starts to pick up again. Now, you notice this yellow one is doing really well compared to the blues. Why is that? Well, it's the tech sector, the NASDAQs. Why? Because everybody's in lockdown and they're now subscribing to Netflix. They're wanting to buy, what do we do with our time? They're buying gadgets and ordering online with stimulus checks and all this sort of stuff. And so we see the tech sector start to pull away from the rest of the market, right? And really perform well. Since then, of course, so we go through 2021, 2022, and of course, now people are starting to come out of these lockdowns. And what's happening now is the Biden administration is now emphasizing we got to get rid of fossil fuels. Now, this decision is huge in terms of economic implications because oil companies are looking at this and going, we've got to pivot. We've got to change. Otherwise, we're going to be dinosaurs here. All right. We've got to now start looking at electrical companies, EVs, and you hear these deals where Congress has put out billions and billions of dollars to put on all these refueling stations for electric vehicles, if you can call them fuel, right? Plug-in places. And the companies are doing deals with places like Starbucks and all of this, so you can have your skinny lattes and all that sort of stuff while your car's charging up out there. The problem with it economically, it's premature. The world was not ready to go kill fossil fuels completely, right? And so what's happened is inflation's gone up because the cost of doing things has gone up because there's oil there, but the oil companies aren't using it. They aren't mining it. They aren't producing it. And so there's a shortage of oil because they're all pivoting and going, we've got to go electric vehicles now, otherwise we're going to be dinosaurs. So you can see the roll-on effect here, guys, of this leading to inflation. And then, of course, now we've got the Federal Reserve just hiking up interest rates, hiking up interest rates, hiking up interest rates, trying to get that inflation down, so they say, to keep it curbed. So again, my example, a political decision leads to economic results, leads to interest rates being affected as well. So you can see how those three factors over two different political administrations have all rolled into each other to give us the result today where you've got people absolutely in a panic with mandates, losing their jobs, their ability to earn incomes. We've seen inflation go nuts, the cost of living go up and wages not rising with it. And we've seen a shortage in Australia in particular in terms of the employment market of having available workers to do so. Well, Australia's coming in and doing this and going, we're going to invite, 1.2 million people on the shores to help with this problem. And the problem Australia has, it doesn't have the housing infrastructure to manage 1.2 million people coming in. So you can see again the flow-on effects of politics, economy, and interest rates, and they just have a flow-on effect. All right. Here's what I want to really emphasize. Uncertainty leads to volatility. And again, remember, as traders, we love volatility. We're embracing it as opposed to running away from it like everybody else. And this uncertainty of what's going on, we go, awesome, here's opportunity. It's opportunity knocking. As I mentioned, the black swan events of COVID-19, flash mobs, September 11, these cause uncertainty, which leads to volatility in the markets and great opportunity when a trader is trading if they're set up with the right strategy to take advantage of these events. And here's the thing, they're happening more frequently when you track history, right? From the 80s, we had the big crash, right? After the big hairspray and the big shoulder pads and all that sort of stuff, there was a big crash. We had the dot-com bubble crash. We had September 11 crash. And now we're seeing it crash a lot more frequently, right? We came out of the global financial crisis. We had COVID-19 in 2020, and these things are crashing more and more frequently. And my whole thing is, rather than run away and go, oh, this is scary, what do we do? Don't get into the stock market. I go, what is the best way to be set up for these opportunities as they present? Because all that's happening is a great wealth transfer is going on in these processes. Every time the market crashes, somebody's cleaning up and making a lot of money. And the question is, are you part of that action? All right, that's how we view it. All that's happening when a crash occurs is money's going from one person to another person, right? And it's really important to bear that in mind, to be a part of these wealth transfers. Volatility makes most investors really nervous, and that's because they equate it with pain and loss. Our students are taught how to embrace volatility and potentially make huge profits from it. And therein lies the huge difference. When the crash of March 2020 occurred, we made our biggest profits for the year, as I mentioned, and so did some of our students. Let's have a look at their results. This guy's Daryl Cockcroft, made over 200% over a number of months in 2020, just resetting his position continually on some gold stocks that he was trading. Daryl loves gold. He worked in the mining sector from South Africa, loves gold, knows gold's mapped out all the different cycles and every month of what its trends are doing over historically. You know, when the season in India buys lots of gold in the wedding season and the gold price goes up because of demand. He's mapped it all out, right? He knows gold better than we do. He gets consistent results looking at gold, copper, and silver stocks. And he just keeps going back to those, looking for the volatility in them and goes from there. He said to me during that period, I remember what you said, that you wanted to make trading as boring as possible. Okay, I get my thrills and kicks outside of trading. You're looking for excitement. Trading is not the place to do it. You want to make it as boring as possible, all right? Which is really weird. But that's what gives you the consistent results. If you want high fun stuff, go scuba diving, jump out of planes, whatever, right? Don't do it in the markets. It'll be too painful. And he wrote, so with that, I'm really watching my risk. Okay, that's the key. Steve, over the Christmas break on the 14th of December 2020, pulled off a 53% return on investment on an individual virtual trade on a solar company. So Daryl does real money. Steve, in his learning process at this time, was doing virtual money, was simulated money. Okay, it's pretend. It's basically practice, okay? And he got a 53% return in his learning process. In his second virtual trade, locked 20% return of investment over the same period. Steve is a builder. And so, yeah, he was wanting a side hustle, you might say, in what he was doing. Since then, he pulled off the biggest virtual trade we've seen to date. On the 3rd of March, he made a single trade 596.9% in one day on a stock called RKT. Now, here's the interesting thing about RKT. Remember GameStop? Some of you might be familiar with that. The guys get on social media, they all say, hey, we hear hedge funds trading this thing. Let's burn the hedge fund, pump this stock up to ridiculous amounts. Well, they did that. And then Wall Street's calling foul. It's like, yeah, whatever, guys, because you've been doing it to the little guy for how many decades now? Well, they were doing it to this other company, RKT Rocket, right? And he got onto this. And so the stock moved in one night, 70%. Right? The stock moved 70%. However, because he was using options, he made 596.9% on that night. And that's how it's done. That's what I'm talking about with leverage. It's for a smaller outlay, you can control a greater move. You can experience a greater move and get greater leverage when that happens. So that's powerful. 2020, Darren turned a virtual account from 100,000 to 144,000 over that 12 months. Remember, this is during a market crash, guys, all right? This is when the market's crashing. And he got this result just checking every few days around his business. He's very busy in his business. And he just checked it, make an adjustment. And he did it on one stock as well. And he traded going up, traded going down, traded going up, traded going down, just the one stock. So you can see how little research he had to do to get that kind of result. That's a 44% return over 12 months on the entire account. Dr. Ho Bing holds the record for the second biggest live trade with our students, 149% return on investment on a single trade on the 11th of May, 2021. He was actually up 300%, but couldn't close out the trade because it was moving so fast, the market. So he had to settle for just 149% after a few weeks. That's tough, eh? Settling on 149%. Junaid, the quiet achiever of the group. He joined us in February 2022. Before we officially started virtual trading, he was doing virtual trades. He's a go-getter. He gained 64% on a position on Apple, then reset the position for another 10% and a bit more for a 98% return on investment. And obviously the stock hasn't moved 98%. He's just been really disciplined in taking profits and resetting, take profit, reset. And did really well at that. And then one morning, about a year later, Junaid rings me and he says he had real money on this trade, about $13,700 on a single trade. And now it's up over 94,000 in value. And he's calling me saying, should I close it out for profit? I think that was in November of that year. And yeah, it's kind of like, well, yeah, I can't give you financial advice, Junaid. You're up how much percent? He held on to it. He ended up making about $46,000 on that. So yeah, he should have closed it out earlier, but you know, still 46,000 profit for one trade. He's pretty happy with that. In 2023, a mystery trader student replaced his former income with trading income. We can't reveal his name due to privacy reasons. He's had an interesting sort of career and that sort of stuff, but you can watch his testimony at that YouTube link if you'd like. Which mystery trader replaced their job income with trading income. It's on our Blue Sky Factory YouTube channel, okay? So you can hear his testimony there. Are they getting large trades all the time? They're frequently making 15%, 22% and set up for those large moves when they occur, and minimal losses have occurred. And that's still true to today. I've watched this over the last 3 years. Very minimal losses have occurred with our students. And I'm really proud of that. That's probably the biggest delight for me, is that they're making consistent wins over those time. So the question I have for you is, how will you set yourself up to take advantage of these wealth transfers, especially if they're happening more frequently? Are you going to, freak out about what's going on, or are you going to look at it and go, there's opportunity here. How can I be part of that setup, that wealth transfer that's going on? So if you want to learn about this is what we do, 20 weeks option trading course. It's 20 weeks because I found this the most successful process. I've been doing this since, for at least since 2013, even before that. I was doing it for probably 3 years before that. So I've been doing it a long time, and I've just found this the best method and most cost effective, because if you were to do it other ways, you'd end up, you might save $1 here, $1 there, but you'd end up over time spending more on it. Whereas this system that we've developed is really the best way to do it, and is getting great results, as you can see with our students. So we take you through the mindset of how a trader thinks, very different from an entrepreneur, very different from an employee, even different from a self-employed person. I've had to really work on some of my students' mindsets and go, hey, you're thinking like an employee in this situation. You need to think like a trader. We take you through options theory. Obviously, to win a game of basketball, you got to know the rules. Well, it's no different to options, okay? You got to know what you're dealing with. Strategies. I don't believe in one strategy you've probably picked up. We teach, up to 6 to 9 of those by the time we're done, so that you've got a lot of tools in the tool bag that you can use when markets change. And then running trading like a business. Everything from emergency planning, what happens if the internet goes down, what happens if your computer dies, right at planning holidays, right through to how does the ATO look at this, how to structure this from an accounting, from an asset protection, tax minimization perspective, all that stuff we look at. And then we want you to learn kinetically paper trading or virtual trading, where it's pretend money, putting on what you've learned onto real market conditions, testing it and seeing how it works. And that's when the pennies, the light bulbs go on, you go, oh, now I get what Derek was going on about intrinsic value or time decay, all these kind of theories. I've got it now. And we go over about 7 strategies, as mentioned, that traders trade options for these 3 reasons: income, hedging, protection, and leverage. And we look at which strategy fits into what category. So what students basically do is we reverse engineer it. They go, well, which one do I want? Am I after income, hedging, protection, or leverage? Okay, I'll define the strategy I want to do that. And then they pick the stock that they think will fit the strategy, rather than the investor mindset of, hey, this is a great stock, I think it'll grow over time. Totally different approach to the markets, okay? The strategy defines the stock. So in this course, we send you 2 hours of video a week to watch in your time. And then we do a live workshop where we catch up for an hour to 45 minutes to an hour to go over the material during the week. This allows you to ask questions. Also keeps you accountable. I found that students, when left to their own devices on an automated course, don't do it, they procrastinate. So it keeps you accountable to do the work as you go through the course. It helps me monitor where the gaps are for you. And I can jump in really quickly and go, okay, you're not quite, we need to fill in this gap here for you and your understanding. I've been doing this a long time and I can identify it very, very quickly. So yeah, it's a win-win for everyone in doing it this way. And with the videos, you can watch them in your time. You don't have to show up live for those 2 hours. If you want to watch it at 2 in the morning because that time suits you, fantastic. You watch it at 7 in the morning while you have breakfast, fantastic. Whatever works for you. It's very lifestyle friendly. One of our strategies that we show, as I mentioned, is how to get a trade to a point where all the risk is gone. The trade is set up for a free bet. And imagine if you had 10 of those set up. So you may scratch 8 of those trades and take some small profits, but 2 of them have great moves for unlimited profit potential. That's advanced stuff, but this is the potential that we can teach you. And getting to a place where the trade is simply trading with profit and not original capital, or as I like to call it, a free bet. All right. So the course, it's $11,995, or if you pay up front, you get a massive discount of just $9,995, $9,995. The next workshop is starting soon. And to enroll, all you have to do is contact Conscious Investor Network for your unique online link in the video description below. So just check out where this video is, follow the prompts, and we'll know, yep, you're part of the Conscious Investor Network, which is important because there's a bonus. If you sign up within 48 hours of receiving this video, you'll get a free 30-minute consultation with myself. My most precious asset is my time, apart from my family, my faith. My time is very, very precious. Got to keep things in perspective here, Derek. But yeah, I'll give you some time here to go through any questions you have on trading, an assessment of what stage of learning you're up to. Those who've got trading experience, I treat them a little bit different from those who are starting out, only because sometimes that can be something that goes against you because you go, oh, I understand this, and you overlook stuff. And we've got to go, whoa, slow down. Let's be thorough here and look at it with fresh eyes. And we just go through that. And what we'll do as well is you'll receive the Trader Starting Kit free, valued at $369. So what that does is a bit of a starting kit to show you what the markets are about, what's out there, and how it all works. Further information to what I've shown today. So there you go, guys. Follow the link below, and I look forward to catching you on the other side of this.
Great, Derek. Thank you so much.
You're welcome. Thank you.